Listen closely because something happened in the global financial markets last night that almost everyone is going to misinterpret. While you were sleeping, the paper silver market on the COMEX experienced a violent price gap, jumping more than 5% in a single trading session. To a retail trader staring at a Robinhood account or a basic candlestick chart, this might look like a simple technical bounce or a relief rally after a tough month. But if you understand the plumbing of the global financial system, you know that a 5% overnight gap in a major commodity is not a sign of a healthy market. It is a sign of a system that is beginning to fracture. We are currently witnessing a historic decoupling between the digital world of high-frequency trading and the physical world of industrial manufacturing. For decades, the price of silver has been dictated by the paper markets in New York and London. Traders who never intended to take delivery of a single ounce of metal moved billions of dollars in contracts, creating a price discovery mechanism that the rest of the world simply followed. But that era is ending. Right now, as I record this, physical silver in Dubai is being transacted at $96 per ounce. Let that number sink in. While the COMEX screen tells you silver is worth $76, the actual buyers in the Middle East are paying a $20 premium just to get the metal in their hands. This is not a localized anomaly. In Russia, the price has hit $98. In Australia, $93. In Canada, $89. The entire physical world has moved to a near triple-digit price point while the paper market was busy painting red candles on a screen. That 5% jump you saw on the COMEX last night was not a bullish breakout driven by momentum traders. It was an act of paper capitulation. It was the moment the exchange was forced to acknowledge a reality it has been trying to suppress for weeks. The ghost in the machine has been revealed. For the man who has invested in silver to protect his family's wealth, the confusion of the last few days has been intense. You saw the price crash to $71 on December 29th, and you likely heard the mainstream media claim that the silver rally was a bubble that had finally burst. They called it a shooting star pattern. They talked about technical rejection. They told you the party was over. But they were looking at the shadow on the wall, not the person casting it. The crash to $71 was an artificial phenomenon manufactured by year-end bank regulations, which we will analyze in depth. The real story of silver right now is the story of a physical shortage so severe that industrial giants are no longer looking at the COMEX price to make their decisions. They are bypassing the exchanges and paying whatever is necessary to secure supply before a massive geopolitical shift occurs on January 1st. We are at the doorstep of a structural repricing that will change how we value tangible assets forever. This 5% gap is just the first tremor before the earthquake. To understand why the silver market just gapped up 5%, we must first understand why it crashed so violently on December 29th. Most retail investors believe that prices move solely based on whether an asset is good or bad. They think that if silver is essential for solar panels, the price should only go up. But the global financial system does not care about your fundamental thesis on December 29th. It cares about the balance sheet. Every major financial institution, from Goldman Sachs to JP Morgan, operates under a strict set of international regulations known as the Basel III Accords. These rules dictate exactly how much leverage a bank can carry relative to its Tier 1 capital. Throughout the year, banks stretch these limits to maximize profit. However, December 31st is what we call a balance sheet freeze, or a snapshot date. On this day, every bank must report its exact risk exposure to regulators. This report determines their capital requirements and their ability to pay dividends or buy back shares for the following year. Silver is a nightmare for a bank's balance sheet at year-end. Because silver is highly volatile and settles daily, it consumes a massive amount of risk-weighted assets. If a bank is holding a large position in silver futures or acting as a market maker for silver derivatives, that position looks like a massive red flag to a risk manager on December 30th. To ensure they are compliant with Basel III and other leverage ratio requirements, these institutions are forced to clean their books. They are not selling because they hate silver. They are selling because they have to present a clean, low-risk balance sheet to the regulators. This creates what we call institutional compliance selling. On December 29th, we saw a massive liquidation of paper contracts. Because the liquidity in the market is thin during the holiday season, this forced selling created a vacuum. The price on the COMEX plummeted to $71 in a matter of minutes. To the uninformed observer, it looked like a total collapse of the silver bull market, but in reality, it was simply the financial plumbing being flushed. The banks sold their paper positions on the 29th to hit their regulatory targets, fully intending to buy them back once the new year began. However, a dangerous thing happened during this year-end flush. While the banks were dumping paper contracts to satisfy regulators, physical buyers in the real world did not follow suit. Usually, when the paper price drops, physical premiums stay the same, and the total price goes down. Not this time. When the paper price hit $71, The physical dealers in Dubai, Singapore, and Hong Kong looked at the screen and laughed. They refused to lower their prices. In fact, they raised them. They recognized that the paper crash was a mechanical artifact of the banking system, not a reflection of reality. This created the massive divergence we are seeing now. The institutions have finished their year-end reporting, and now, in the first days of January, they are rushing back into the market to re-establish the positions they were forced to sell. This is the reason for the 5% gap up. It is the sound of the world's largest banks chasing the price higher because they realized that while they were busy playing accounting games with the regulators, the physical market moved completely out of their reach. The magic of December 31st is over, and now the reality of January begins. The 5% overnight jump on the COMEX is the first visible crack in a facade that has been maintained for over 50 years. To truly understand why silver is hitting $96 in Dubai while the New York screen says 76, you have to understand the fundamental lie of the modern commodity market. That lie is the belief that a digital contract is the same thing as the metal itself. For decades, the financial world has operated on the assumption that paper silver and physical silver are 1 and 100% interchangeable. Today, that assumption is dead. In a healthy market, the paper price acts as a discovery mechanism for the physical world. If you want to buy 1,000 ounces of silver, you look at the ticker, add a small dealer premium of perhaps $2 or $3, and that is your price. This is how the system is supposed to work. But what we are witnessing right now is a structural break. When the gap between the paper price and the physical transaction price reaches $20 or more, the paper price is no longer discovering value. It is merely a reflection of the internal leverage of the banking system. The COMEX is essentially a casino where participants trade promises to deliver metal. Most of these traders use extreme leverage, often 20 to 1 or higher. This means that for every 1 physical ounce of silver sitting in a vault in New York, there are hundreds of paper ounces being traded on the screen. As long as nobody asks for their metal at the same time, the system functions perfectly. But the moment physical demand from industrial giants and sovereign nations exceeds the available supply in the vaults, the paper market loses its ability to dictate reality. Look at the numbers coming out of the major global hubs. In Russia, the price of $98 per ounce is not just a high premium. It is a declaration that the Russian market has completely abandoned the COMEX as a pricing reference. In Dubai, a city that serves as the gateway for gold and silver flow between the East and West, the $96 price point tells us that the physical metal is being hoarded by those who understand what is coming. When the physical price is 30% higher than the paper price, the paper market has become a derivative of a reality it can no longer control. This divergence is the single most important signal a silver investor can watch. In 1980 and 2011, when silver prices crashed, the physical premiums crashed right along with them. You could get the metal easily if you had the cash. But today, the paper price is trying to recover with a 5% gap. Yet you still cannot find physical silver at that price anywhere in the world. This is what we call a broken market. The paper contracts are being settled in cash because the exchanges simply do not have enough metal to satisfy the standing delivery notices. When the structural break becomes this wide, it triggers a feedback loop. Industrial buyers who used to rely on the COMEX for their supply are seeing the $96 price in Dubai and realizing that the $76 paper price is a trap. If they wait for the paper price to be right, they will run out of raw materials for their factories. So they start buying physical at any price, which drives the physical price even higher, further widening the gap. The paper market is now in a desperate race to catch up to a physical reality that has already gone parabolic. As we stand here on December 31st, 2025, the global silver market is staring directly at a geopolitical cliff. Tomorrow, on January 1st, 2026, the People's Republic of China will officially activate a state-controlled licensing system for all silver exports. To the average person, this sounds like a minor bureaucratic change. To the industrial world, it is the equivalent of a new iron curtain falling across the global supply chain. You must understand the scale of China's dominance to realize why this is causing panic buying in Dubai and a 5% gap on the COMEX. While China only mines about 13% of the world's silver, it controls between 60 and 70% of the global refining capacity. This means that silver ore from South America, Africa, and Australia travels to Chinese soil to be purified into the high-grade bars and pellets required by modern industry. By implementing this licensing regime, Beijing is not just restricting a metal, they are seizing absolute control over the flow of 70% of the world's tradable silver. The details of this policy, set by the Ministry of Commerce in late 2025, are designed to consolidate power. Only 44 large, state-certified companies have been granted permission to export. Small and mid-sized exporters who provided the marginal liquidity to the global market, have been completely shut out. Furthermore, these approved giants must now apply for individual licenses for every single shipment. This gives the Chinese government the power to turn off the silver tap to any country or company at a moment's notice. It is the same strategic playbook they used with rare earth elements, but applied to a metal that is far more critical to the global energy transition. The timing of this ban is a masterstroke of economic warfare. The global silver market has already suffered through 5 consecutive years of structural deficits. In 2025 alone, global demand reached 1.24 billion ounces, while total supply struggled to hit 1.01 billion. That 230 million ounce shortfall has already drained inventories at the COMEX and the London Bullion Market Association to historic lows. Now, just as the Western world's cupboards are bare, China is closing the door. Why is China doing this now? The answer lies in their own industrial survival. China has become the world's solar superpower and the leading manufacturer of electric vehicles. They have calculated that they need every ounce of silver they refine to fuel their own domestic economy and maintain their lead in the green energy race. They are no longer interested in selling their strategic resources to the West in exchange for depreciating fiat currency. They are choosing to keep the silver and export the finished high-value products like solar panels and EV batteries instead. This is why we see Dubai trading at $96 today. Industrial procurement officers from Europe and North America are in a state of outright panic. They know that once that clock strikes midnight tonight, their access to 60% of the world's refined silver could be cut off or subjected to political whims. They are front-running the ban, buying up every physical ounce available regardless of price. Elon Musk himself has warned that this situation is not good, noting that silver is essential for countless industrial processes. We are moving from an era of globalized trade into an era of resource nationalism, and silver is the first major casualty. In the world of finance, we often talk about price as a choice. A hedge fund manager chooses to buy silver at $30 because he thinks it will go to $40. If the price drops to $25, he chooses to sell and take his loss. But in the world of industrial manufacturing, price is not a choice. It is a secondary concern. The primary concern is continuity. If you are the head of procurement for a solar panel factory or an electric vehicle assembly line, your worst nightmare is not a high price. Your worst nightmare is a zero supply. This is the fundamental reason why the physical price of silver has disconnected from the COMEX. Factories do not care about candlestick patterns, moving averages, or the 5% gap on a computer screen. They care about keeping their machines running. Right now, we are seeing a massive shift in behavior, from just-in-time inventory management to just-in-case hoarding. This is what is driving the $96 price in Dubai. The industrial giants have looked at the data and realized that silver is the indispensable metal of the 21st century. Consider the solar industry. In 2025, global solar capacity installations exploded, and silver is the conductive paste that makes these panels work. There is no known substitute that matches the efficiency of silver at scale. If a solar company cannot get silver, they cannot produce panels. If they cannot produce panels, they breach their multi-billion-dollar contracts with utility companies and governments. Paying $96 for an ounce of silver that represents only a small fraction of the total cost of a solar installation is a logical business decision. Shutting down a factory and laying off 10,000 workers because you refuse to pay $20 above the paper price is corporate suicide. This inelastic demand is now colliding with the reality of the AI revolution. Every high-end semiconductor, every data center server, and every advanced sensor in an autonomous vehicle requires silver. The demand is not coming from silver stackers in their basements. It is coming from the procurement departments of the most powerful corporations on Earth. These entities do not negotiate with supply shortages. When they see the China export ban on the horizon, they do not wait for the COMEX price to drop. They enter the physical market and bid whatever is necessary to secure the metal. This is why the paper market is losing its relevance. The COMEX was designed for speculators to bet on price movements. It was never designed to handle a situation where every industrial user on the planet wants to take physical delivery at the same time. When a manufacturer buys a silver contract on the COMEX, they are often settled in cash. But you cannot build a solar panel with a stack of $100 bills. You need the physical atoms. The 5% jump we saw overnight is the paper market's first admission that industrial demand is winning. The shorts, those who have sold paper silver they do not own, are realizing that they cannot suppress the price forever when factories are willing to pay nearly $100 in the open market. We are witnessing a transition where silver is no longer being priced as a precious metal for investors, but as a critical industrial raw material. In this new paradigm, the chart is irrelevant. Only the inventory matters. Whenever silver begins a vertical move, the financial media and seasoned traders immediately reach for their history books. They point to the spectacular rise and fall of 1980 or the peak of 2011. They use these dates as a warning, suggesting that silver is a dangerous bubble that always pops. However, if you are using those years as a map for today, you are going to get lost. The landscape has fundamentally changed. To understand why this current gap up is different, we must analyze the structural mechanics of those past rallies. Let us start with 1980, the year of the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt famously tried to corner the silver market. Their strategy was simple: use massive amounts of leverage to buy up every available futures contract and demand physical delivery. They drove the price from $6 an ounce to a staggering $50. But here is the crucial detail. The shortage they created was entirely artificial. It was a speculative squeeze driven by a single family. There was plenty of silver in the world. It was just being hoarded by two men. When the COMEX changed the rules implementing Silver Rule 7 to restrict position sizes and jack up margin requirements, the Hunts were forced to liquidate. The bubble popped because it was built on a mountain of paper leverage, not a lack of physical atoms. Now, look at 2011. Silver rallied to nearly $49 an ounce. This was driven by a post-financial crisis fear of inflation and a massive wave of retail speculation. It was the era of the first silver message boards and the rise of the first silver ETFs. But once again, the rally was primarily a paper phenomenon. Global mine supply was actually increasing, and industrial demand was relatively stable. When the COMEX raised margin requirements 5 times in just 9 days, the speculative air was let out of the balloon. The price collapsed because the people holding the contracts were traders looking for a quick profit, not manufacturers who needed the metal. Today, in 2025, we are in a completely different market regime. This is not a speculative cornering of the market, and it is not a retail-driven frenzy. This is a supply-demand mismatch of a physical nature. In 1980 and 2011, the problem was too much paper leverage. Today, the problem is too much industrial demand and not enough metal. You can raise margin requirements all you want, you can flush out the speculators, and you can crash the paper price to $71, but that will not create a single new ounce of silver. When the paper price crashes, but the price in Dubai stays at $96, it proves that the scarcity is real. Unlike the Hunt brothers, the buyers today are not 2 individuals. They are thousands of corporations across the globe. You cannot force a solar panel manufacturer or an electric vehicle giant to liquidate their physical silver by changing the trading rules on an exchange in New York. They do not own paper contracts. They own the actual metal. This is why the 1980 map is broken. We are not in a speculative bubble. We are in a structural repricing of a disappearing resource. You cannot pop a shortage. You can only reprick the asset until demand finally drops, and at $96, the world is telling us we are not there yet. While the world watches the price of silver, the most dangerous signals are coming from a place most people never look: the plumbing of the global banking system. To understand why the paper market crashed on December 29th and why it is now desperately gapping higher, we have to look at the repo market and a specific indicator called SOFR, the Secured Overnight Financing Rate. This is where banks lend to each other using treasury bonds as collateral. It is the heartbeat of global liquidity. In a healthy system, SOFR stays low and stable. But in the final days of December, something went wrong. SOFR jumped above the Federal Reserve's discount window rate. This is a massive red flag. The discount window is the lender of last resort the emergency facility banks use when they can't find cash anywhere else. When the market rate for lending between banks becomes more expensive than the Fed's emergency rate, it means the private balance sheet capacity has completely evaporated. The plumbing is clogged. When banks run out of balance sheet capacity, they don't just stop lending, they start liquidating. They look for the assets that are the most expensive to hold from a regulatory standpoint. Because silver is volatile and requires daily margin adjustments, it is one of the first things to be sold off to free up space. The crash on December 29th was a mechanical result of this liquidity squeeze. Banks weren't selling silver because they thought it was worth $71. They were selling it because they needed to clear their pipes before the year-end deadline. But here is the paradox. While the banks were starving for balance sheet space, the physical world was swimming in cash. The divergence we see $76 on the COMEX versus $96 in Dubai is a direct result of this broken plumbing. The paper price represents a system that is struggling with regulatory constraints and liquidity bottlenecks. The physical price represents the actual value of the metal in an environment where cash is looking for a safe haven. This repo market stress tells us that the paper price is a lie. It is a price dictated by banks that are being forced to sell assets they would rather keep. Now that we have crossed into January, the pressure is beginning to ease. The pipes are opening back up, and the 5% gap we saw overnight is the sound of that liquidity flowing back into the market. The banks are no longer forced sellers. They are now frantic buyers, trying to reclaim the silver they dumped just a few days ago. The lesson here is simple. Never confuse a liquidity crisis with a fundamental collapse. The silver market didn't break because people stopped wanting silver. It broke because the banks ran out of room to hold the paper contracts. As the repo market stabilizes, the paper price has no choice but to chase the physical reality. The leak in the plumbing has been patched for now, but the damage to the COMEX's credibility is permanent. As we close out the year, 2025, one of the most powerful signals in the entire financial landscape is screaming for attention. It is a number that professional bullion traders watch with obsession, yet it remains almost invisible to the general public. This is the gold to silver ratio. To put it simply, this ratio tells us how many ounces of silver it takes to purchase a single ounce of gold. Right now, with gold trading near $4,360 and silver at $76 on the COMEX, the ratio sits at approximately 57 to 1. To the uninitiated, 57 might seem like just another number, but in the context of history, it is a compression trigger. Throughout the 19th century, when the world operated on a bimetallic standard, this ratio was legally fixed at 15 or 16 to 1. Even in the modern era, the average has fluctuated between 40 and 60. Whenever this ratio stretches to extremes like the 125 to 1 we saw during the pandemic panic of 2020, it signals that silver is historically undervalued compared to its yellow cousin. What we are witnessing today is an aggressive compression of this ratio. At the start of 2025, the ratio was above 80. Today, it has dropped to 57. This tells us that silver is outperforming gold by a massive margin. Gold has had an exceptional year, rising over 60% due to global tariffs and geopolitical tensions, but silver has surged over 140%. When silver starts moving faster than gold, it is a sign that the market is shifting from a search for safety to a search for scarcity. History shows that when silver enters a true bull market, the gold to silver ratio does not just revert to the mean, it overshoots it. In 1980, the ratio collapsed to 17 to 1. In 2011, it dropped to 30 to 1. If we are truly facing a structural physical shortage as the $96 price in Dubai suggests, then a move back to 30 to 1 is not just possible, it is probable. If gold stays at $4,300 and the ratio hits 30, the price of silver would need to exceed $140 per ounce. This is why the 5% overnight gap is so significant. It represents the catch-up phase. Silver is the more volatile, more industrial, and more scarce sibling of gold. When the ratio begins to compress during a time of high geopolitical stress, it creates a momentum vortex. Investors who feel they missed the gold rally flock to silver because it appears cheap by comparison. This retail and institutional inflow, combined with the industrial panic we discussed earlier, creates a vertical price move. Keep your eyes on this 57 level. If the ratio breaks below 50, it will signal the start of the parabolic phase. In this stage, the paper market will no longer be able to ignore the physical reality. The compression of the gold to silver ratio is the mathematical proof that the world is waking up to the reality of silver's disappearing inventory. Gold is the king of wealth preservation, but silver is becoming the king of price discovery. As we look ahead into the first weeks of January 2026, the massive gap between the $76 paper price and the $96 physical price in Dubai cannot exist indefinitely. Arbitrage is the strongest law in finance, and this 30% divergence is a signal that the system is under extreme pressure. There are only two ways this gap resolves itself, and both represent a historic turning point for silver holders. The first path is convergence. In this scenario, the paper market on the COMEX is forced to acknowledge the physical reality. This is what the 5% overnight jump was the very beginning of a frantic chase. If convergence happens, we will see the COMEX price move vertically to catch up with the global physical market. This would mean silver gapping up day after day, moving from 76 to 85, then 90, and finally leveling out near $100 to match the prices in Dubai and Russia. This is the orderly path, but it will be devastating for anyone holding a short position, as they will be liquidated in a massive short squeeze. The second path, and the one that should concern every systemically important bank, is total decoupling. This occurs when the physical market continues to run higher, moving from $96 to $120, while the paper market remains stuck or even crashes due to further bank liquidations. If the gap becomes too wide, the COMEX effectively ceases to be a price discovery mechanism. It becomes a closed loop of paper traders betting on a ghost. In this scenario, we see force majeure events, where the exchange shuts down or forces cash settlements because there is no metal available for delivery at the paper price. Industrial buyers have already chosen their path. By paying $96 in Dubai today, they are telling us they no longer trust the paper price. They are bypassing the exchanges and securing metal at any cost before the China export ban takes effect at midnight. This is a vote of no confidence in the digital financial system. If you own physical silver, you are currently positioned on the right side of this decoupling. You own the atoms that the world needs, while the rest of the world owns promises that may never be fulfilled. The next 72 hours are critical. If the COMEX continues to gap higher, we are seeing convergence. If the COMEX stalls while global premiums expand further, we are entering the chaos of total decoupling. Either way, the era of cheap paper-priced silver is over. The market has finally realized that you cannot build a green energy future or an AI revolution out of digital contracts. You need the metal, and the metal has moved to a new home in the triple digits. As we stand at the threshold of 2026, the silver market is no longer just a trading chart. It is a battleground between paper accounting and physical reality. The 5% gap on the COMEX is a warning shot, and the $96 price in Dubai is the new baseline. For the serious investor, this environment requires a disciplined, strategic framework. You cannot navigate a structural shortage using the same rules you used for a speculative bubble. First, you must prioritize physical certainty. In a world of decoupling, a paper contract is only as good as the exchange's ability to deliver. If you own physical silver, whether it is in a private vault, a sovereign mint coin, or a professional depository, you own the only thing that matters when supply chains break. Do not be shaken by the volatility of the paper price. If the screen shows $71 but you cannot buy an ounce for less than $90, the screen is wrong. Your strategy should be to hold until the paper market either converges with reality or becomes completely irrelevant. Second, understand the industrial floor. Unlike the rallies of 1980 or 2011, today's price is supported by the most powerful industries on Earth. Solar energy, electric vehicles, and AI data centers are not going away. Their demand is inelastic. This creates a floor under the price that did not exist in the past. Even if a global recession hits, the transition to green energy and digital infrastructure will continue, and silver will remain the indispensable conductor of that transition. Third, manage your leverage and risk. While the outlook is historically bullish, silver remains the devil's metal for a reason. Its volatility can be extreme. If you are trading paper contracts with high leverage, a mechanical flush, like the one we saw on December 29th, can wipe you out even if you are right about the long-term direction. The safest way to play a structural shortage is with unleveraged physical holdings or fully funded positions. Do not let the bank's balance sheet problems become your financial disaster. Finally, keep a close watch on January 1st. The activation of China's export licensing system is the catalyst that could turn this steady climb into a vertical surge. If global inventories continue to dwindle and the gold to silver ratio keeps compressing toward 30-1, we are entering a new paradigm where triple-digit silver is not a dream, but a necessity. We are living through the end of the paper price era and the beginning of the age of scarcity. The 5% gap was just the beginning. The real story is the $20 gap between the screen and the street. Position yourself accordingly, because the physical world is finally taking back